Whether you're invested in crypto or more traditional equities, you've probably experienced moments where you're sitting in front of your computer watching the charts and biting your nails, unsure if now is the right moment to hit that buy button. Because as soon as you do, a giant red candle daggers the chart, and you're stuck sitting in the dark in disbelief, tears falling silently down your cheeks. Hello and welcome to Alpha Finance. This is the channel to watch if you want to learn more about personal finance, investing in cryptocurrency. However, before I get into the topic, do me a favor, subscribe and hit the like button because it really helps with the YouTube algorithm. Thank you, and now let's get into it. Today's educational programming is all about taking the indecision and sting out of trying and failing to perfectly time the market. Anyone with any investing experience knows how hard it is to hit that proverbial bullseye. But you've been looking at this problem in wrong way. Instead of obsessing over your timing of the market, you should focus on your time in the market. And there's a beautifully simple and effective strategy for doing just that: dollar cost averaging. With dollar cost averaging, or DCA, you can reduce your investing costs and your exposure to risk. Here's the SparkNotes version of the strategy. Investors can reduce the inherent impact of fluctuations in the stock market by acquiring a fixed number of shares at predetermined periods over time, rather than a single large purchase. Investing over time with smaller amounts should also reduce overall expenses and increase profits. When investing in stocks, ETFs, or mutual funds, dollar cost averaging is a method for reducing the impact of price fluctuations. Dollar cost averaging is a strategy wherein an investor spreads out their investment in a given asset by acquiring smaller amounts of that security over a longer period of time, rather than making a single large investment at a single, higher price. This lessens the possibility of overpaying at the current market price. Not all changes in price are upward. But if you spread out your purchases across time, you increase your odds of paying a lower average price. Putting money into an investment on a regular basis is essential for long-term success, and dollar cost averaging makes that easier. Dollar cost averaging is a common investment strategy that many people use automatically when contributing to a 401k or similar employment retirement plan. Now, I completely understand the temptation to study the economy and look for a perfect opening for investing, so let's contrast market timing and dollar cost averaging a little more. The reason maximizing time in the market is key is because asset values tend to grow over the long run makes dollar cost averaging a viable strategy. Of course, these asset values do not always go up in the short term. Instead, they experience wild swings between extreme highs and lows that defy easy analysis. Many people gamble on the belief that they can predict when asset values will be at their lowest and so make a profit by snagging those assets right at the bottom. In principle, this seems straightforward. These short-term market predictions are very difficult in reality, even for skilled stock pickers. What is low now may be high next week. And the top of this week might end up seeming like a steal a month from now. The best pricing for any item can only be determined in hindsight, by which time it is too late to make a purchase. If you try to timing the market and pick up shares in a hot new brand, you may wind up purchasing at a price that has plateaued after seeing major price appreciation. You stand to lose a lot of money if you attempt to predict the market. Major financial institute Charles Schwab found that investors who attempted to time the market had far lower returns than those who just invested consistently using dollar cost averaging. DCAing is deceptively easy. With dollar cost averaging, you buy a specific quantity of an asset on a regular basis, regardless of your mood. This strategy entails purchasing fewer shares at higher prices and more shares at lower ones. Let's pretend you have $1,200 earmarked for mutual fund easy money this year. You can either put in $1,000 at once at the start of the year or at the end of the year, or you can put in $100 per month. Initially, there may not seem to be much of a difference between the two options, but if you buy $100 every month for a year, you may end up owning more shares than if you purchase them all at once. Dividend reinvestment strategies, or DRIPs, are another great example of dollar cost averaging. A DRIP is a method that enables investors to reinvest dividend payments in the form of new shares or fractional shares of the equity investment providing the dividends. This system is usually managed by brokerages for a wide variety of mutual funds and exchange-traded funds, greatly expanding the pool of potential investments from which you can choose. The automatic, recurring purchases made possible by a DRIP are a powerful DCA method, much like 401k contributions. However, the principle of dollar cost averaging is consistent reinvestment of dividend payouts, even if the amounts change from month to period. Those who have less money to invest might also benefit from dollar cost averaging. As a practical matter, dollar cost averaging allows you to start investing even if you're only working with babysitting money or loose change from under the couch cushions. With dollar cost averaging, you put in a certain amount of money at regular intervals depending on what works for your budget and let the market do the rest. In this manner, you can take advantage of market growth even if you don't have a big nest egg or fancy job. With dollar cost averaging, you invest consistently over time, even during market downturns like today's. Most investors naturally feel uneasy about sticking with their portfolios during market downturns. But if you don't keep putting money into the market or take money out of your current assets while prices are low, you can lose out on the upswing that follows. Charles Schwab's researchers found that investors who kept their money invested during a bear market had higher returns than those who tried to time the market. Even in idealized scenarios, dollar cost averaging does not always result in a smooth outcome. Because of this, it is often wise to invest a substantial quantity of money as quickly as possible after acquiring it. Investing a decent chunk of money all at once can be a mental and emotional strain, thus spreading out the investment of a large sum over time also helps you get over your hesitancy. Also, remember that dollar cost averaging almost always outperforms investing in a single amount. Dollar cost averaging has beaten out lump sum investment 2/3 of the time. Dollar cost averaging is preferable to investing everything at once because it provides stable returns while lowering the danger of becoming one of the majority who try to time the market and then despair when it turns against them. However, dollar cost averaging often offers 3 advantages that might lead to higher profits. Number 1. Stay away from bad market timing. Number 2. Invest rationally, not emotionally. Number 3. Put the future in perspective. When used properly, dollar cost averaging protects investors against their own irrational decisions. As the market fluctuates, investors' emotions, particularly fear and greed, can very well lead them to make irrational trading choices. If you use dollar cost averaging, you may purchase when others are selling out of fear, locking in a discount and positioning yourself favorably for long-term profits. Since the market generally rises over time, dollar cost averaging might help you see that a stock market collapse or bear market can really be a fantastic long-term investment opportunity, rather than a danger. Bear in mind that dollar cost averaging is most effective during market declines. Finally, here's a way to give dollar cost averaging a boost. Brokerages often allow you to automatically reinvest dividends from equities and mutual funds. That allows you to keep buying shares, increasing your potential profit in the long run. There you have it. DCAing is a no-brainer for investors, especially those who are just beginning to build their net worth. Will you start dollar cost averaging after learning about this powerful strategy, or will you go on binge watching YouTube videos, wondering why you still aren't a millionaire? Let everybody know down in the comments. It's also interesting to hear what my future millionaire audience thinks. And if this video sufficiently drilled into your head why you need to DCA, please show your appreciation by leaving a like. It really helps the channel. As always, thanks for watching.